Hey, welcome to this tutorial on Keltner channel trading strategy versus Bollinger Bands. We're going to do a little comparison between these two types of envelopes, and they're called envelopes because the lines envelop above and below the midline. And the midline in this case we're going to use as the 20-period moving average, which is right here. So right now I have, as you can see, the Keltner channel on here. I've got Disney daily chart. And one of the big differences between Keltner channels and the Bollinger Bands are the Keltner channels use an average true range to set the channel distance. So these are the channels here. And then we've got a 20-period moving average here in the middle. And by the way, that is a 20-period exponential moving average. That's typically what's used for Keltner channels. Now, Bollinger Bands, they are calculated differently instead of using an average true range. So when people use this as a trend indicator, then primarily what they're looking for is for it to show an impulse move here, strength to the upside, hit the upper Keltner channel. Now see here it did not. But here it does, and so that shows a strong impulse move to the upside, and then they're looking for it not to come back and retrace and hit the bottom channel in order to maintain strength to the upside. And that philosophy in general I agree with. Big part of my trading is looking for the direction of the dominant energy in the market, and this would be one way of doing it. So that works very well here in this particular situation. Let's look at another one. So as you see here, we had been in a downtrend, and then we come back, we reverse, we hit the upper Keltner channel, and the market does continue up and up and up and up, and then it comes back down. And well, let's move the screen forward here so you can see. And so in this case, actually we'll just go ahead and move it all the way forward. And you know, it looks pretty great. It does come down and hit the lower Keltner channel, and it does not come back and reach the upper one, and continues with a nice downtrend. So that's the basic use of it, the basic way of reading it. And it works pretty well if you've got a market that is having a rather low volatility trend. And Disney tends to move that way. However, not all markets do. So let me show you some other examples. I'll show you one more. Now I brought up GLD, so just as a different example. So on this one, we hit the lower line, we go back up, hit the lower one here, point this out for you. And so that would indicate an impulse move to the downside, but then we have one hits to the upside, which is what we don't want in order to start a downtrend. But then it really goes down. By the way, another thing to notice is look how far price bars get below the line. So it doesn't, if you get a high volatility market or particular time in a market, it's not going to contain price action very well. Bollinger Bands do a better job of that. One way around this, however, in some software programs, you can do multiple multipliers. Well, that's good, Barry. Multiple multipliers. So you could do, instead of just having one offset multiplier here, you could do 2, you could do 3, and that'll help. A lot of people actually do that, and that's good. Then you'll have 2 bands above the mid-range and 2 bands below the mid-range. So that's one way to kind of help to answer that problem. But again, you see that we go down here well below, and then we come back up well above, and then we go back again well below. And so this is one of the problems, and one of the reasons I said that I don't like using this as a trend indicator is because it's typically based on 20 periods, 20-period exponential moving average. And the 20 bars is not enough to have a trend, in my opinion. The word trend means, in the Webster's dictionary, the extended general direction of something. So a trend by definition is a long-term move, not a short-term move. I think a 20 period is too short of a term to measure trend. So I like to go with 50. And obviously there's room for different opinions there. That's no problem, but that's my opinion. And so down and down and down we go. I've added the Bollinger Bands now. They are the red envelopes here and here, and you'll see I'm using essentially the same settings even though the equation is different. So I'm using the same settings essentially that we do for the Keltner channel, but again the equation is different, so that's why obviously they are different. Now one thing you'll notice right away is that the Bollinger Bands, the red lines, are able to capture more or contain more price action than the Keltner channel. So the Bollinger Bands, they will expand and contract more, and of course that's because they're not based on average true range, they are based on the standard deviation, which varies. So they measure volatility much better in my opinion. So I use them more for volatility than I use them for trend. Again, we're using a 20 period moving average, so I wouldn't use it for trend. But for volatility, I think it is very good. So also another thing that I like about the Bollinger Bands is that not only do they contain price action or more price action, so for example here, you just get 3 bars above the Keltner channel, but here's a signal that I use a lot, where you get a real body outside of the Bollinger Band. And to me, that shows extreme move, a very, very unusual high volatility move that is generally unsustainable. So the Keltner channel doesn't show you that because you get so many bars above and below it all the time. But you don't get as many bars above and below the Bollinger Bands, and so it's an unusual activity, and when it is, it's usually measuring exhaustion, that move is coming to an end. And that's very valuable information, very valuable. So as we come down here, for example, we see that yes, we're hitting the bottom here. The two levels are pretty even, but as volatility increases, the Bollinger Bands start to move apart. That's a signal of increased volatility, something that the Keltner channel doesn't give you. Then, when we get down to here, then this is very important. Notice all these bars here, all those bars are below the Keltner channel, but only these couple bars here are below the Bollinger Band. When I see that, then I say, oh, okay, Bollinger Band captures the vast majority of price action, and because now we have gone down so far that we've broken below that, I think we're coming to the end of that move. And that is a great signal that works a lot, and there you go. So it comes back up, and that is the end of that down move, end of that trend, if you want to measure trend that way. If you like this video, please understand that sure, it's free, but if you got value from it, you actually have a moral obligation to pay it forward by clicking that beautiful little share button below and share it with other people. In addition, if you're watching this on YouTube, please click the thumbs up icon and leave a comment. I really love your comments. They really encourage me to create more free tutorials. I'm also giving away one of my favorite trade strategies. I trade this setup all the time. It's called the rubber band trade. It has a very, very high win-loss ratio. You're going to love it. It's a simple trade, and I'm going to share it with you for free. I can teach it to you in about 26 short minutes. Get my rubber band trade strategy absolutely free by clicking in the image in the top left corner, or if you're on a mobile device, click on the little eye with the circle around it in the top right corner of this video. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.